revenue driver for Robinhood. We talked about that a lot yesterday in its debut, with more than 80% of Robinhood's revenue coming from that. But what exactly is it and how does it work? As always, we turn to Brian Cheung for an explainer on this week's Yahoo U. Brian.
Well, Geeko, class is in session. As you mentioned, Robinhood's public debut yesterday is again surfacing questions about how a stock brokerage makes money when commissions are zero. Well, the answer, it's all about a relationship between a brokerage like Robinhood and wholesale market makers. Now, give me a quick moment to explain this. So let's walk you through this with an example. So let's say our esteemed colleague here, Zach, calls up a brokerage firm and says, I'm bullish on this company called Cheung shoes. These guys make dope sneakers, and I want to get on these tendies, my guy, right? Now, back in the day, you had to literally call a broker to do this. But today, the call is just hopping on your trading app like Robinhood and then placing an order for 100 shares of this company. Now, in a payments for order flow structure, the broker takes the order and passes it on to a wholesale market maker. This would be a Citadel Securities or a Virtu Financial. And these market makers are the specialists at actually executing the trades, right? So they'll go out on the hunt for Cheung Shoes stock and buy or sell a stock at publicly quoted prices on the New York Stock Exchange, for example. So, okay, where in this process then is the natural question for payment for order flow? Well, let's take a second. So when Zach asked to buy shares of Cheung Shoes, he put in a price that he's willing to pay. So let's call it $100. Now, from the market maker's perspective, this is called the ask price, right? What Zach asked for. But as part of an order, there's also a second price, the bid price. And this is the price that they actually execute the trade on. So if Zach asked to buy it $100, but the wholesaler was able to find it at a better price, like $98, that's nice, right? That'll lead to a $2 difference, and this is called the bid-ask spread, again, from the perspective of the market maker. And in this case, the wholesaler will pocket a portion of this, let's say $1, and then they'll call that a finder's fee, and the other dollar will be paid back to the brokerage that gave them the order in the first place. And that is the payment for order flow. And then if you want to break that down even further, let's say that $1 is then broken up. The brokerage can say, all right, I'll take, let's say 50 cents, and I'll say, hey, Zach, I found this stock at effectively $99.50, and then the business, the brokerage firm, can pocket the rest of the 50 cents to run its business. Now, the metrics show just how popular this has become for all the top brokerages. So this data comes from Alphacution. It uses SEC and also company data, and it shows the 4 top brokerages by payment for order flow revenue over the last 3 calendar years. And you can see just between 2019 and 2020, revenue from this specific business almost tripled. And at Robinhood specifically, which is the blue section here, that actually was an increase of about tenfold, from about $69 million in 2019 to $687 million in 2020. And I want to show you this new chart, and this zooms in specifically to Robinhood's payment for order flow revenue by quarter. Again, keeping the theme of their IPO this week. And this is interesting because it shows how much money Robinhood specifically netted during the meme explosion of the first quarter of this year. Again, you'll recall that was in January, February. And the $110 million difference between the quarter 4 of 2020 and quarter 1 of 2021 shows you also the breakout of the market makers involved for all that revenue. And the biggest partner for Robinhood by far, the purple section, and that, folks, is Citadel Securities, which, by the way, is not to be confused with Citadel's hedge fund. Now, you can all see why this is such a hot debate, right? I mean, the structure of payment for order flow is the reason for why zero commissions exist in the first place. But it's also added a middleman, and it's raised questions about the incentive structure for which brokerages pair up with which wholesaler, how the incentives end up bleeding through to ultimately the consumer or the brokerage itself. But it's all just a sobering reminder, guys, that nothing really is for free. There's always a cost somewhere baked in there. But that wraps up this week's Yahoo U.
Yeah, it also goes to show, too, I mean, why it's not just a Robinhood issue here, as the other brokerages also now involved. The regulation specter that hangs over them could be impacting all of these brokerages, too. So, Brian Cheung, appreciate you breaking that down for us.